In this video, I'm going to share with you how I use NVIDIA to help me generate a weekly income. Hi, I'm Jim, and in this educational and entertaining video, I'm going to share with you how selling a covered call using NVIDIA helps me generate a regular weekly income. So for this covered call trade, I'm going to be using an ETF with the symbol NVDX. For those of you not familiar with it, NVDX is a 2 times leverage exchange traded fund, or ETF, that tracks along with NVIDIA. Now that 2 times leveraging sometimes can be intimidating, but what it really means is that as NVIDIA moves up or down, NVDX, the ETF, does twice as much. So that's the 2x leverage. So if NVIDIA moves up 1%, NVDX moves up 2%. But if NVIDIA moves down 2%, then NVDX moves down 4%. I've got a daily chart of NVDX shown on the screen, going back roughly 3 to 4 months. So you can see that NVDX is currently in an upward trend. Now let's take a look and compare this to regular shares of NVIDIA and symbol NVDA. So here we can see the candlestick is NVDX and the simple line is NVIDIA, or symbol NVDA. And we can see that the shares of stock of NVIDIA over the past 3 to 4 months are up 66%, whereas NVDX, the 2 times leverage ETF, is up 153%. If you haven't joined my free user community for stock option traders like us, be sure to join. It's totally free at school.com/simpleoptiontrading. I'll leave a link in the description down below. Here's a quick summary of NVIDIA, symbol NVDA. We could see it's currently trading at just slightly over $180 per share. Compare that to shares of NVDX, the 2 times leverage ETF exchange traded fund. It's trading at $18.45 per share. When I showed you the chart comparing the two, we saw how NVDX tracks along with NVIDIA. So basically, it's trading along with the price performance of NVIDIA stock. One of the advantages I like of trading the ETF is that owning 100 shares of the ETF would cost me $1,845 at today's prices versus over $18,000 if I were to directly own shares of NVDA. So I currently hold 100 shares of NVDX in my portfolio, and I'm thinking about using them to sell a covered call option. Hey, wait, time out. What is selling a covered call? Think of selling a covered call option like this. Let's say I own a house and I paid $100,000 for it. But you know what? I may be thinking, I'm willing to sell this house next month for $120,000. And then a serious buyer that's interested in my house may be considering it because they think the $120,000 purchase price is a good value, but they're anticipating that prices in the area may shoot up even higher within the next 30 days. So getting the house for $120,000 is a steal. So they accept my offer and lock in the deal. So now I'm guaranteeing that I'm going to sell this person my house for $120,000 within the next 30 days. And so it doesn't matter if somebody comes up to me within the next day and offers me $125,000. I'm locked into a contract with the buyer to sell my house for $120,000 within the next 30 days. So in return for reserving my house for this particular buyer, I'm going to want something in return. So I tell the buyer, yes, I'll guarantee you the $120,000 price for the next 30 days, but I want $2,500 up front, and that money is non-refundable and it doesn't apply towards the purchase price. So if you decide to purchase the house on or before the 30 days, you're still going to pay me the full $120,000. And if you decide not to purchase the house, I still keep the $2,500. So when I sell a covered call using my shares of stock, I'm guaranteeing that I'll sell them at a certain price. That's the strike price. And I use the expiration date to specify the length of the contract. So if the buyer decides to exercise the option contract, then I sell my shares of stock at that price agreed upon, specified by the strike price, but I also keep the premium payment that I received up front for selling the option contract. But if the buyer decides not to exercise the option contract, I keep the premium amount that I received for selling the option contract in the first place, plus I also keep my shares, and I can use those shares again to sell another covered call option contract. As it turns out, I'm not married to these shares, and what I mean by that is I'm okay if they get assigned as a part of the option getting exercised, and so I'm going to specifically set the strike price equal to my cost basis. So I'm okay having my shares get assigned and not receiving any profit from the price appreciation. Now let's take a look at this trade using my covered call analyzer. So today's date is August the 15th, and I'm going to be trading symbol NVDX with an expiration date of August the 22nd of 2025. I'm going to be using a strike price of $19, and I've specified a premium payment of 40 cents per share. My cost basis for these shares is also $19. Now let's run through the results. So I'm going to be selling a covered call for symbol NVDX, And the current market price is $18.45. Now, I hold 100 shares in my portfolio, which means I can sell one option contract. Now, with an expiration date of August the 22nd, that would make the length of this option contract 6 days. Now, because I specified an option strike price of $19, which happens to be the same as my cost basis, if this option gets exercised, I'll get paid for my shares, but there won't be any price appreciation, so there's no profit there. But when the option contract does get filled, I will receive 40 cents per share as the premium payment, meaning I'll receive a total of $40 as the premium payment, and that's the 100 shares times the 40 cents per share. So the total profit potential from this particular trade is $40. It's the total I receive from the premium payment. And that $40, well, that represents a 2.11% return based on my initial investment. So from a profitability standpoint, this trade makes a lot of sense to me. So I'm going to go ahead and sell this covered call option contract. 3 hours later. So good news, I submitted this option to sell the covered call contract and the order was filled. So let's take a look at the details. All right, so I opened up my trading platform and we can take a look at my trading history, specifically where I sold the covered call for symbol NVDX. So here you can see that I sold the call with a $19 strike price and an expiration date of August the 22nd. Now I submitted this order on August the 15th at 9:41 a.m. Pacific time, and then the order got filled later that morning at 12:37 p.m. So roughly 3 hours after I submitted the order, it actually got filled. Now, when this order got filled, I was paid 40 cents per share as the premium payment, which means I received a total premium payment of $40 for selling this option contract. So my option contract got filled. I received $40 as the premium payment, which got immediately credited to my trading account. Now I just have to wait for the expiration day to arrive to find out what happens, whether or not this option contract gets exercised or expires worthless. But in the meantime, I could also decide whether I want to close out this contract by executing a strategy known as buying to close. So I can actually buy back my option contract at a certain price, and the difference between what I was paid in the premium and how much I actually paid to buy it back, that difference will be my net profit based off of this trade. And by closing out the contract, I collect the net payment from the premium and I get to keep my shares. So I shared with you how a covered call works. I gave you a real life example and we'll find out what happens on the expiration date. And if you haven't joined my community, be sure you join over at school.com/simpleoptiontrading. Thanks for joining me. Hope to see you in the next video.